Afternoon, everyone, and thank you for joining us. Welcome to the Dialogue Series session. I'm Anchal from the AASB. The Dialogue Series is held jointly with CANZ and CPA, and the topic for today is cash flow statements. The session will be chaired by Senior Manager Dr. Sabine. Please note that the views shared in this session are not the views of the presenter's organization, but their personal views. The session will also be recorded and made available on the AASB website. You're welcome to ask questions using the Q&A function, and we will try to answer your questions if time allows. And with that, I'll hand it over to Sabine.
Thank you, Anshang. And welcome, everybody. My name is Sabine Schürer. I'm a senior manager here at the AASB and will be hosting the session today. So as usual, we will start off with a presentation, which is today provided by my colleague, Dr. Hang Tran. Hang will be presenting the findings of a AASB research project titled Cash Flow Statements and Related Matters, the Australian Evidence. And it was undertaken by Hang, the AASB Research Director Eric Lee, Professor Millicent Chang, and AASB board member Professor Dean Hanlon. Hang's presentation will be followed by an introduction to the AASB's project on statement of cash flows and related matters by Nick Barlow, who is the project lead of this project at the IFRS Foundation. And after Nick's presentation, we will open the floor for discussion with our panel audience and Q&A questions. And with that, I hand over to Hang. Thank you, Hang.
Thank you, Sabine. Can you see my share screen, Sabine?
Yes.
Beautiful. Thank you. Give me 1 second. Okay. Hey, hello everyone. My name is Hang, Assistant Manager from AASB. Welcome to the presentation today, Statement of Cash Flows and Related Matters, the Australian Evidence. This research is led by AASB Research Director Dr. Eric Lee, together with Professor Millicent Chang from University of Wollongong and Professor Dean Hanlon from RMIT University. So Sabine allocated 10 minutes for my presentation. What can you expect in these 10 minutes? I will start with the background of AASB cash flow project, follow with the data breakdown. After that, my presentation will focusing on the key findings from our research. So without further ado, let's get started. So what motivated AASB to start cash flow project? In April 2022, based on feedback of third agenda consultation, AASB added cash flow project to its research pilot. In September 2024, AASB officially moved the cash flow project to its work plan. The purpose of this project is to explore potential improvement to IAS 7 Statement of Cash Flow that equivalent to AASB 107. Responding to this call, AASB officially kicked off as a cash flow project in April 2024. Our main objectives are, first, research and suggest ways to enhance cash flow statements and related matters to meet the needs of users. Second, we would like to provide the Australian evidence for the consideration of the AASB to amend or improve IAS 7. AASB cash flow project has two phases. In phase 1, starting from Q2 to Q4 2024, we focus on financial report analysis. We investigated the annual reports of the ASX Top 50 based on the market capitalization in financial year 2023. In phase 2, starting from Q4 2024 till H1 2025, we conducted in-depth interviews with relevant stakeholders, including users, preparers, and auditors. So for our presentation today, we're focusing on insight gained from both phase 1 and phase 2. Let's have a look at our data breakdown. There are diverse industries in the sample of phase 1, financial services, together with mining, materials, and construction, representing for the most significant percentage in our sample, accounting for 20% and 18% respectively. 14 interviews were conducted, including 6 users, 5 preparers, and 3 auditors. In the scope of today's presentation, we share findings from four key topic areas. First, direct and indirect matters. Second, cash and cash equivalents. Third, disaggregation and incorrect voluntary disclosure. For this section, we focus on the disclosure of maintenance and growth capex and the segmental cash flows. Last but not least, we will focus on the free cash flows. Issue 1, that is a direct and indirect matters. So most Australian entities have been using direct and indirect matters for cash flow presentation for more than 20 years. Unsurprisingly, our research findings also show that majority of Australian entities, accounting for 72% of our sample, used both direct and indirect matters. This is totally different from the US and Europe, where the indirect is much more dominant. The sample entity in insurance, retail, telecommunication, software and service, logistics, and transportation all use both matters. The use of only indirect matters were particularly common in mining, materials, and construction industry. The interview also further reinforced the benefit of both direct and indirect matters. Direct method is normally perceived to be more costly but more meaningful from the perspective of preparers and users. So from Australian perspective, we suggest that AASB should mandate both direct and indirect matters to enhance the comparability of cash flow data. Australian evidence also suggests that both preparers and users have adapted well to the availability of both direct and indirect matters. With the second issue on cash and cash equivalent, under IAS 7 paragraphs 6 and 7, there are two principal attributes of cash equivalent. They are short-term, that representing for maturity characteristic, and highly liquid, that representing for readily convertible characteristic. Currently, there's no hard threshold regulated by the IAS 7 regarding the short maturity. However, in the wording of the standard, 90 days is suggested. Our research findings show that 40% in our sample did not split between cash and cash equivalents. 90-day threshold is still very popular with 62% of the sample entities. However, when we conducted interviews last year and in the Q1 of this year, a lot of interviews challenged the threshold of 90 days for short-term maturity, and several interviews also suggested to remove the current wording, says 3 months in IAS 7. So based on our research finding, we suggest at IAS 7 to reconsider the concept of short terms, focusing on the significance of the purpose test in defining the cash equivalent. Normally, the purpose test of meeting short-term cash commitment should still override the threshold. With the third item of disaggregation and incorrect voluntary disclosure, currently under IAS 7 paragraph 50, it encourages entity to voluntarily separating and disclosing growth and maintenance capex and cash flow of reportable segment. Our interview with user acknowledged the great benefits of disaggregation of growth and maintenance capex and segmental cash flow. However, they also raised a concern about the cost benefit of this additional disclosure. Our research also further showed that there's limited disaggregated information on the growth and versus maintenance capex, when we just only have 4% of our sample disclose about this. And also none of the Australian entity provided the segmental cash flow. Our research findings suggest IASB to consider first to provide more comprehensive guidance on capex disclosure. Second, develop clear definition, including the illustrative example, differentiating between growth and maintenance capex. And third, assess further the cost and benefit of segmental cash flow as part of the IASB future segment reporting project. The last item in my presentation is about free cash flow. Although free cash flow is not mandated by both AASB and the IASB, however, the free cash flow is very significant for user. Our research findings show that 52% of entities in our sample provided FCF disclosure. The disclosure of FCFs is very popular in some of the industry, for example, energy and utility with 100% of the sample, mining, material, and construction, 90% of the sample. Additionally, we also found that free cash flow appeared in various parts of the annual report, for example, like company report, company outlook, financial highlights, director report, or remuneration report as well. The interviews with users, preparers, and auditors further confirmed the usefulness and relevance of free cash flow for many Australian entities. However, interviewee also strengthened our prior views on the great variation of the free cash flow disclosure and measurement. We often raise a question for our interviewees. Do you think it's possible and useful for AASB to provide a universal definition of free cash flow? And normally we receive very mixed view on this aspect. So our research team recommend to AASB to first consider the need to standardize free cash flow, and second, investigate the information gap. Particularly, is there any information that is currently not reported but should be reported in the financial statements that could help user and preparers to determine free cash flows more accurately? Overall, our research findings suggested that AASB 7 is not broken and a comprehensive review is not needed. However, targeted improvements are encouraged, particularly in some specific area that we have just raised. So that's all about my presentation. Thank you so much for your listening. Back to you, Sabine.
Thank you very much, Hang. So that was a very insightful overview into the current landscape of cash flow reporting in Australia. And we've heard some very interesting observations and recommendations, and we will come back to some of them in our panel discussion. But before we do that, we will hear from Nick Barlow, who will give us an overview of the AASB's project on statement of cash flows and related matters, for which Nick is the project lead at the IFRS Foundation. He joined technical staff in 2018 and worked on primary financial statements, which resulted in IFRS 18, presentation and disclosures in financial statements. And here in Australia, we have adopted this as AASB 18. Prior to joining the IASB staff, Nick worked in audit with KPMG in Canada and EY in the UK, before moving into regulation with the UK Financial Reporting Council. Thank you.
Yeah, I couldn't find the mute button. Thank you. Thank you for that introduction. And happy to be here. Good afternoon to everyone. So, Hang already shared a little bit about the background of our project and where it's come from. So from the IASB's last agenda consultation. And we started off as an official project just in September last year. And it's probably worth mentioning that it came from the agenda consultation as one of the projects that had quite strong feedback to become a project, and in particular feedback from investors. So that pushed it onto the list. And as I say, we got started in September. So that feedback, because it came from the agenda consultation, gave us a good starting point of the feedback. And Hang's already touched on some of the things you'll see that overlap with what we'd heard through that agenda consultation. And broadly, we heard sort of 7 high-level topics where there's our potential areas for improvement with IAS 7. Now, first, some raised questions about whether there might be changes needed to requirements for classifying cash flows. So some suggested there are no specific guidance for some specific transactions where they see diversity in practice. And others pointed out that with the introduction of IFRS 18 and categories in the statement of profit and loss, that might warrant a rethinking of categories in the statement of cash flows. So we also heard, particularly from many investors, that more disaggregation would be useful, specific to the statement of cash flows. Some of the areas that they mentioned specifically are, as Hang mentioned, specifics that are encouraged within the standards, but not necessarily requirements. So those being separating capital expenditures between growth and maintenance, or cash flow information by reportable segment. But just a general sentiment that more disaggregation might be helpful in the statement. Many pointed out that there's a wide use of information about commonly used cash flow measures, so things such as free cash flows, but perhaps slightly wider than only that measure. Those, of course, are not included within the statement of cash flows and not defined currently within IFRS accounting standards. But many said that consistent information about those measures and how they're calculated would be useful. Some said there's specific aspects around the definition of cash and cash equivalents that are unclear. As Hang mentioned, the 90-day rule and the 90-day guideline is very popular. Some see it very much as a rule. Others see it more as a guideline. And so some said that leads to some diversity and there could be clarity around the definition. We also heard around the definition, though, that some would like to see that potentially expanded to include a larger range of investments than would currently meet the definition within IAS 7. Now, the effects of non-cash transactions might seem a strange topic for a statement that deals with cash flows, but many question whether there should be more information to help reconcile changes in the statement of financial position, which investors said they use the statement of cash flow for, at least one of the uses. They pointed out that the transactions needed to understand this change are not reflected in the statement of cash flows. Now, some examples of the types of things they were looking for are to do with changes due to leases, purchases of assets with non-cash considerations, and things like share-based payments. We've heard a little bit about the direct versus the indirect method. I think this has been a long-standing debate, and again, something that came up in the agenda consultation with some questioning whether there should be changes to the requirements there. And then finally, there was questions raised about the relevance of the statement of cash flows for financial institutions in its current form. So with that as a list of our possible topics, we started out with an initial phase for this project of initial research to make sure we fully understood each of those topics and the extent to which they might be problems. Now, that research consisted of discussions with individual stakeholders, so including investors, preparers, accounting firms, and regulators, and also discussions with the AASB's consultative groups of preparers, investors, and other national standard setters. We also did a review of a sample of financial statements to get a sense of what current practice is, though that sample size was quite small and really more indicative than something that allows us to make larger conclusions. To complement that, we've also tried to leverage the work of others to the extent that we could. So looking at academic research, looking at past IASB projects, and importantly, reviewing the work of other standard setters with similar projects. So including the research that we've heard about today here by the AASB, and Hang and Eric were both kind enough to talk with us during the development of their project so we could fully understand the findings that they were seeing and see how those compare to what we were hearing. So that work is now complete, and we reported our findings to the board last month. We think we were able to get a good understanding of each of these issues and a good sense of where stakeholders' priorities are around each of them. So at a high level, what we saw was that from an investor perspective, things such as the disaggregation of information and that information about non-cash transactions were their biggest priorities. In contrast, for preparers and some other stakeholders, more guidance around classifying transactions into the operating, investing, and financing categories was higher priority, as was an improved definition around cash and cash equivalents. But where we saw overlap between most stakeholders was around wanting more information around these common cash flow measures such as the free cash flows, and also confirming that from many's perspective, the statement of cash flows for financial institutions has limited use. Now, that said, we did hear numerous suggestions about how to improve that, either through discrete disclosures, all the way to the extreme end of saying think about making it exempt for making financial institutions exempt from preparing the statement of cash flows. So having discussed our findings, as I say, with the board last month, as well as taking these findings to our preparer, investor, and national standard setter advisory groups, we're now in the process of developing a proposed project plan for the board that will try to narrow down the topics that the project will focus on and try to find the most efficient order, taking into account the relationships between some of these issues, and also the progress of other projects that the IASB is taking on, which may interact. So one that comes to mind is the post-implementation review of leases, where we've heard a lot of feedback that relates to the statement of cash flows. So the current plan is for the IASB to review this project plan in May, after which time we can get into the real meat and bones of the project and start trying to address the issues that the IASB decides to take forward. So I will stop there and turn it back to you, Sabine, and get into the discussion.
Thank you very much, Nick. And for any audience members, if you are interested in more information about this topic, then of course you can always find that on the IASB website. So now we will open the panel discussion, and I will just briefly introduce our illustrious panel members to you. Today I'm joined by Professor Millicent Chung from the University of Wollongong Business School. Millicent has an extensive list of publications in top-rated accounting and finance journals. She is a recipient of several research grants, including a prestigious grant from the Australian Research Council. She also has been the past president of the Accounting and Finance Association of Australia and New Zealand, AFANS, and recently completed a sabbatical with AASB, where she worked, among other things, on the cash flow research project that we've just presented. Also here is Ken Leo, partner and head of strategy and risk at Realm Investment House, which is a fund manager specializing in the management of credit and bonds. Ken joined Realm in 2013 and has over 30 years of investment industry experience. He was previously managing director at BlackRock, where he served as chief investment officer of domestic equities, head of investment strategy of Science Active Equity, chair of the risk management committee, and member of the executive committee. He led the team which built the Australian quantitative equity business from inception. And prior to BlackRock, Ken was head of investment research at Mercer and has advised several investment institutions. Next is Rebecca Morgan, head of finance at Eleanor Investors Group. Rebecca has spent over 20 years working in the property industry with roles at Ernst & Young, Dexus, New City, which is based in Japan, Rosenholmes, and GPT. In her current role, Rebecca oversees Eleanor Investors Group's finance, funds finance, and financial planning and analytics function. Rebecca is a fellow of the Chartered Accountants Australia and New Zealand, chair of the Property Council of Australia Accounting Committee, a member of the AASB Disclosure Initiative Advisory Committee, and the CAANZ Property Sector Community Group. And last but not least, we are joined by Ram Subramanian, who is the external reporting lead at CPA Australia. And Ram's responsibilities include formulating policy positions and commenting on reporting and audit developments, including providing input from a not-for-profit and public sector perspective. Ram is also involved in the development of technical guidance and resources for CPA Australia's membership and other stakeholders, and representing CPA Australia in various forums. Previously, Ram has worked in senior roles in public practice in the UK, where he was involved in managing the technical advisory services of major professional accounting bodies. Before we start with the panel discussion, I would like to remind the audience that we are happy to take questions during the discussion. We will try to fit them in where we can. And so let's start. And maybe we can start with a reference to our theme. Today, is cash still king? Or in other words, are cash flow statements still important? Ken, as a user, would you like to share your thoughts?
Yeah, so I've got experience in both the equity and the debt side of the user list. So in equities, because you're talking about long-dated perpetual types of notes that shouldn't necessarily ever get repaid. You're more focused on earnings, which is, I suppose, a proxy for sustainable, long-term cash flow generation. But you don't need to worry about near-term cash generation because the dividends are ultimately, elective. As a debt investor, it's all about cash because you're making promise payments at a particular date and maturities are fixed. You don't do that, you default. So when you're a debt investor, it's quite different. You're focused on two things: the probability of default, that is being able to make your cash payments as promised, and secondly, in the event of default, what kind of coverage you've got. Loss given default is the other thing, which is the balance sheet elements. So for a debt investor, I'll say that cash flow is very, very important for us to look at. In addition to that, you'd obviously be looking into the notes to sort of see the maturity profiles coming through and the need for refinancing as well.
Thank you, Ken. And Nick, from a standard setters perspective, what have you heard from stakeholders on the importance of cash flow statements?
Yeah, we've heard pretty consistently that it is important. I think one of the important pieces that we've heard is that it works together with the other financial statements, so that it's seen holistically, and so forms a piece of the information. Although depending on the industry or the particular user, as Ken pointed out, that becomes more or less important. But always a consistent message that it still provides useful information.
Yes, and so now that we've established that indeed it is something that the users still very much look out for, and probably also internally is used to plan cash flows. Another area that we've heard from before was the categories of the cash flow statements, and in combination with the AASB 18 or IFRS 18 presentation and disclosures of financial statements, which also proposes operating, investing, and financing categories. The question arises as to what extent those categories should be the same or maybe similar. So, Ram, do you have any thoughts on the categories of financial statements and the cash flow statements? Yeah.
Yeah, on the face of it, you're quite right. It's been as a result of the recent issue of AASB 18 or IFRS 18, the three main categories in the income statement are labeled the same as the three current categories in the cash flow statement. Of course, the cash flow statement is much more well established and has been around for years. AASB 18 also brings about some consequential changes to the cash flows standard to bring about some alignment. So, for example, interest and dividend inflows must always be included under investment activities unless these form part of the entity's main business activities. Similarly, interest and dividend outflows will be under financing. So there is some alignment already being brought in through IFRS 18 or AASB 18. Coming back to your question on whether there should be alignment between the three categories in the income statement and in the cash flow statement, no, I don't think a total alignment is necessary or desirable for that matter, or even possible for that matter. For example, if we look at the basis for conclusions to IFRS 18, it provides a rationale for why the three categories in the two statements have different objectives and have been developed to meet those objectives. For example, the investing activities category in the cash flow statement has the objective of identifying investments made in long-term assets that can include investments in operating assets. But the income and expenses from such operating assets will be classified in the operating category in the income statement. So there is a clear difference there in how the cash flow statement deals with investing in long-term assets and how the same thing is applied in the income statement. For example, depreciation for an asset used in the main business activity would go through the operating category in the income statement. But on the other hand, the inflows and outflows relating to that asset would go through investing in the cash flow statement. So there is a clear difference there. Anecdotally, we know that informed users are aware of the differences between the income statement and the cash flow statement. But there is always a possibility that on first look, someone would expect the three categories in both the primary statements to be aligned. It's a natural expectation. That does need to be addressed, and education around the objectives of the two statements should go some way in addressing that. There are, however, some areas the IASB could address. I think Hang in her presentation earlier said that targeted improvements might be the way to go with IAS 7, and that's obviously what Nick presented on just now. For example, tax payments are included as a separate line item in the income statement under IFRS 18, but there are no equivalents in the cash flow statement. So that there are other areas as well, like cash received from factoring of trade receivables. Should that be treated as operating or financing in the cash flow statement? That's a question. Like Nick said, the IASB is conducting a project looking at the cash flow statement. And so hopefully some of these issues will be addressed as part of that project. And maybe one of the answers could be around the labeling itself of the categories, because at the moment they're labeled exactly the same. Maybe that's an answer that needs to be considered as we go forward.
Thank you very much, Ram. And would you like to share some standard setting thoughts on this, Nick?
Well, I'm not sure how much I can add, Ram. Your response was really comprehensive, which is great from my perspective, having been involved in IFRS 18. I would just say, I think I would echo what we heard in our most recent round of research, echoed what we heard in the development of IFRS 18, that users said they didn't desire an alignment. They did use the statement, or they do use the statement for different purposes. And some of those differences in particular that Ram pointed out in terms of wanting capital asset additions, for example, to be reflected in the statement of cash flows as investments rather than as they would come through in the statement of profit or loss, with the income and expenses being recognized in the operating category. The investor said that the way they use the statement of cash flows, that reflected that. They weren't confused. They understood the differences between them, though they did acknowledge that to the extent things can be aligned, that's desirable. They're intuitively, I think, as Ram pointed out, you would expect them to be the same. And I think, as you pointed out, we'll certainly look at that feedback, and the IASB will consider whether there's opportunities to bring some of those things closer in alignment. And as a team, definitely some of the things we have in mind are what you've pointed out, things like tax, things like discontinued operations, where we've seen a little bit of diversity in how those are treated today, and so dealing with those in a way that aligns may also help with the diversity and practice of how they're reflected in the statement of cash flows. So a few thoughts there.
Thank you, Nick. Another area of interest related to the disaggregation of cash flow items, and Hang mentioned in her presentation as an example the distinction between growth and maintenance CapEx. So another question that I thought would be interesting to discuss would be about where we would like to see as users further disaggregation, and what principles should be used for disaggregation. And again, we've got aggregation, disaggregation principles in AASB 18. Should they maybe equally be applied, or should there be any differences? So Rebecca, maybe you would like to share your thoughts.
Yeah, sure. I mean, I'm from the property industry, and so the operating CapEx, what we call operating CapEx versus development CapEx, is a big distinction for us. And it plays into something that I think we'll touch upon a bit more later on, which is free cash flow. For us, operating CapEx, which really includes leasing incentives, lessor works, and the sort of CapEx that maintains your building at a certain level rather than actually increasing the value of that, such as development-related works, is really something that we look to fund out of operating cash flow. And that's really where our free cash flow measure is sort of driven from. But you won't see it on the cash flow at the moment, because at the moment the CapEx related expenditure is all in one line item for us. And so a lot of property industry players, I believe, have started to split that out on the cash flow because it's something that investors are particularly looking for. So for us, at any rate, in our industry, that's probably the main item that is important to split.
And Ken, I think from a user perspective, where would you like to see more aggregation?
Yeah, so the CapEx sort of and growth exposures, I guess I saw that coming out 15, 20 years ago, coming out of the resources markets instead, where it was very, again, similar way that Rebecca was referring to in resource markets. If they were expanding a mine, that was clearly expansion CapEx. If they were maintaining a mine, it was, operating. It was very clear. And that we found that extremely useful because you could then use that as a base for present valuing the existing operations and then trying to figure out what the new mines were worth and the likelihood of actually doing something with it. And with mining, you actually can discount cash flows because they're actually quite engineered, and the sort of digging out the gradients and stuff like that was quite planned. So we found that really, really useful. In a similar way with property as well, that's also useful because you have a chance to have a look at the cash flow generation capability of the asset. And so, it's if something happened, you could just choose to defer the expansion. So you can just sit there and go, what's the genuine free cash flow? Can it support my the debt that we've taken on? And in fact, many sort of assessments of the quality of the debt, the ratings you might assign to it are also based on free cash flow. So there is a very strong need from a debt investor's perspective to differentiate between those two. It also, it gets into the blurry regions when you move into, things that aren't so distinct. Like if you're an operating company, then you've obviously got things you can do that are voluntary that you could push off to next year or the year after that. Again, that's important for us to know. So if you can preserve cash in a difficult time, we need to know what that is. But there's no easy way to discern, where you might draw the line. So it gets a little bit hazy. But anything that we can get that sort of says what's the most defensive cash generating position you can be in is useful from a debt investor's perspective. So I would definitely encourage that, steps in that direction based off already the very strongly proven value from at least resources and property.
Thank you, Ken. Just a reminder to the audience, if you have any questions, please use the Q&A function to post them. So the next question we've prepared was earlier this year in the March meeting, the AASB expressed a view to consider building on non-cash transactions disclosures. And so what non-cash information is actually useful for investors for decision making, or what was the feedback that the AASB heard in this area? Nick, if I may start with your thoughts on this, non-cash disclosures.
Sure. Yeah, as I mentioned in the upfront presentation, this was something that investors said quite strongly that we talked to. That was one of the key pieces of information that they were looking for. And as I mentioned, there were sort of two elements. I think some in this spirit of using the statements together, look to the statement of cash flows in some respect to see the non-cash changes in the balance sheet items, and they mentioned that some of those are not reflected within the statement of cash flows itself. Now we do have disclosure around financing activities, as you'll be aware, where there's a requirement to show the cash and the non-cash changes of those. But investors said more transparency in a similar way would be useful around things like working capital and to some investors for all of the balance sheet items. And so understanding that cash movement or that non-cash movement and how much is included in the roll forward of assets and liabilities was an important piece of information. I think there was also an element of what users would refer to as sort of transactions that are economically equivalent to cash. And there is some overlap here, but the one that always sticks in my mind is around leases, and you have sort of the debt side of the cash going through the statement of cash flows, but there's the other element of sort of if you wanted to compare that to a purchase of an asset, an acquisition of debt and purchase of an asset, you don't have that movement of cash flows like you would, and so you don't have something coming through for the establishment of a right of use asset, and so information to be able to see those movements was also something that was on their radar.
Are you muted, Sabine?
Thank you very much. Sorry. Sorry, coming up into my screen. So the other question that we had, or another topic that we found in the research, was on the free cash flows and disclosures related to free cash flows. Rebecca, I think you mentioned the importance of free cash flows. Could you maybe share your thoughts again from a preparer's perspective?
Yeah, sure. Probably not so much from a preparer's perspective, but at least from an organisation's, internal machinations perspective. I guess what users and the preparers themselves need to understand about the free cash flow is how it links to their distribution policy. Because a lot of people, I think, link their distributions to a reported earnings number. But if that doesn't align with your free cash flows, then you can run yourself into a lot of trouble if you're sort of driving gearing up as a result of distributing income or cash that you don't actually have in the vehicle at that time. And so I know, for example, at an organisation that I was previously at, they changed, particularly over COVID, where you had a lot of receivables building up on your books, but you weren't getting the cash for those, obviously, but it was still appearing in your earnings. That they actually switched to a free cash flow method of determining distributions to ensure that they weren't simply financing distributions out of debt. And I think that's really what free cash flows is sort of aiming to show. It's aiming to show, are you actually financing your business out of your earnings and the operating elements of your business? And are you only dipping into your debt to expand the business? And that talks to the long-term viability of that business. So in my mind, free cash flows might be different for different industries because there are certain things that those industries need to hold money back for. But the concept of free cash flow, I think, is probably relevant to every business. And so just to go one step further on that, it doesn't mean that you must be distributing free cash flow and only free cash flow. You might be building up a war chest for, a big item. Like Apple is famous for doing, or you might be wanting to run your gearing up to improve your returns to investors, but that should come out in your strategy, and you can talk to that in terms of how your distribution policy ties to your free cash flow.
That's very interesting. And Millicent, what is the academic literature proposing about free cash flow disclosures?
Thanks, Sabine. The free cash flow, the concept of free cash flow has been used in the literature for a long time, especially in finance, especially in the financing, where the concept of, as Rebecca mentioned, the distribution through dividends or to pay down debt or to reinvest is very important, and that's what investors are interested in. Interestingly, as Hang mentioned in our look at the top 50 ASX listed companies, 1 in 2 reported free cash flows, and these companies were the ones that Ken and Rebecca were talking about. They were the mining companies and the construction companies that were providing this information. But our users did not think it was important for the standard setters to set a definition for free cash flows. All they want is enough information, enough itemized information so that they can estimate free cash flows themselves, which I thought was very interesting given the usual want for more disclosure.
Or I might just jump in there again, because I think that one of the other things that possibly would be important is to show how it is that your free cash flow reconciles back to your operating cash flow. I think if you've got at least that much information, then the investors can work out whether they think you're retaining enough information or enough cash within the business to do what you need to do.
Right. So rather than providing a definition, a reconciliation might be more useful. That's
I think
interesting.
so, but maybe Ken would be better to comment on that.
Yes. Yeah, Ken, do you have any thoughts on this?
Yeah, so I'm surprised by the feedback that the Millicent received actually on that one. I think I'd prefer not to have to estimate something if I can actually get it straight. And maybe I might disagree with it, but it's a starting point, and you know more than the preparer knows more. So this is to do with the direct and indirect, I suppose. I think both are actually useful, but they're useful for slightly different purposes. So first of all, the free cash flow comes through, and again, you can sort of see the near-term possibility of generating enough cash to pay for your debt. So I find that to be very important. But the indirect method is also highly important because it's from that you can assess whether or not they're over cash distributing or under cash distributing. So it gives you a better notion as to whether or not you're kind of being fooled by a point in time report from your your cash flow statements. So both are important and both views are important.
So Ken, are you a proponent of companies disclosing both methods then, the indirect and the direct method?
Yeah, absolutely. For example, the indirect method is very useful to sort of see whether or not the quality of the earnings is is impaired in some way. You just look at the cash generation. Are they just draining inventory? Is there like an over belief in the the quality of the receivables? Is the inventory even properly valued? Is it aged and stuff like that, right? You need to have that to figure out if the cash flow statement is misleading you in some way. But I also need to know what the cash is, right? So before I can form an opinion on it, I wouldn't mind knowing what the starting point is. And that's best to get it from the cash flow statement itself. But you can see why both are important, and missing one or the other gives you an impaired view as to what's actually going on.
And Millicent, what have we heard in the research?
Yeah, that's overwhelming. The research is overwhelming in the incremental information provided by the direct method over the indirect method. But again, in our interviews, the users certainly found both methods useful to reconcile items between the methods and with the income statement there, in order to work out the the permanence of the earnings or the longevity of the cash flows, and forecasting the future cash flows and earnings. However, what is really interesting from the academic research is that the users actually use the information in the provided by the direct method, because we see this reflected in the bid-ask spread, and also a reduced bid-ask spread when the direct method is provided, and also this information shows up in earnings. So, when we were concerned with whether users are actually using the information provided in the way it was intended, it's pleasing to see that the information is incorporated into price very quickly.
Right. Nick, did you have any, from my understanding, the disclosing both is a bit of, it's not necessarily very common overseas, outside of Australia. So did you have any feedback in your research on this issue?
No, certainly it was. I mean, one of the areas that we looked into, and I think what we found was interesting, because we're aware of the academic research, and that it generally says that the direct method provides more useful information. I think what we found is, as you say, outside of Australia, the indirect method is the dominant method, is the most used, and it's not often that at least that we found that the direct method was provided. I think. From my perspective, personally, more interestingly, is when we spoke to both preparers and users, they weren't necessarily interested in the direct method. Now, I should qualify that that's not everybody, but the majority view was we like the information we get, we find that useful, we don't see what having the other information would be useful for, and so there was very little appetite for change. It was the view was really and we get what we need, and we don't see a need to change it. And that seemed on both sides of the fence. And maybe that's because for those we spoke to that use the direct method, we found, as in the research that was presented earlier by Hang, often the indirect is also provided. So I think that in that case, they're probably not missing it. I guess, as I say, from a personal perspective, I was a bit more surprised that those that get the direct didn't feel they were missing something, but that seemed to be the predominant view.
That is very interesting indeed. Now, to hear from private not-for-profit and public not-for-profit perspective, Ram, in your constituency, you obviously have many stakeholders in that sector. And one of the issues that they are facing relates to restricted cash. Is that correct, Ram?
That's correct, Sabine. My favorite sector, by the way, the private and public not-for-profit sector. Of course, restricted cash could arise for a number of reasons, and one could be the funder or the provider of the cash is saying to the entity, you must use this cash for a particular purpose. And that's where the restriction arises from. When we look at the cash flow statement itself, one of the primary benefits from the cash flow statement is to provide information to users on liquidity. So that could be one of the uses that the reader will be getting from that primary statement. There are questions here as to whether a reader can properly assess liquidity or perhaps even solvency of an entity when considering the cash reserves the entity holds, which may or may not include restricted cash. So when cash inflows are included in the cash flow statement, this of course means that these are assets of the entity because they have control over the cash, otherwise they wouldn't be including it in the cash flow statement in the first place. So that's the starting point. So cash is received, which is in the entity's control, but there are restrictions on its use, which could be placed by the party who has provided the cash. And what you could consider there is, in a sense, you're recognizing the cash as an asset on the one hand, but the entity has also created an obligation that it will expend the cash in a particular way. So that might mean that when considering liquidity or even solvency of the entity, inclusion of any restricted cash in the net cash position might not present a true picture. So this raises an interesting challenge. In this context, I'd probably like to highlight something that came across my desk a few years back. We did a research report, CP Australia did a research report called The Horizons of Financial Reporting that was published back in 2022. One commentator there noted that financial reports include both hard numbers and soft numbers. And hard numbers are those that you have a high degree of certainty over. And they actually pointed out cash and receivables as hard numbers. And softer numbers include a fair degree of estimation or uncertainty around them. Interestingly, we are looking at a similar issue here, but what is in that context was considered a hard number. Here you're looking at different aspects to it. And it does also bring into question a few other issues. For example, borrowing capacity that looks at net cash as an indicator. How does that play into a situation where there's restricted cash included in the cash reserves? Using net cash flows as a KPI for performance, especially where you've got restricted cash included. Assessing financial sustainability of the entity. Lack of consistency and comparability because you're looking at two different entities, one having restricted cash in there, another one doesn't. Are they comparable? Perhaps not. What I noted was looking at this particular topic, in the US, the FASB, the Financial Accounting Standards Board, has sought to address the issue of restricted cash in one of their accounting standards, AASB 230, I believe. However, they have not specifically sought to differentiate between restricted and unrestricted cash in the statement itself, as far as I can tell. Rather, what they've done is they've required entities to disclose information around the restrictions in relation to the restricted cash in the notes. So that may be a solution to consider. But having said all that, we haven't heard many concerns with the presentation of restricted cash in the cash flow statement here in Australia for not-for-profits. So if there is sufficient concern, evidence being gathered that stakeholders want to see something here that is distinguishing between restricted and unrestricted cash, we may have to look at solutions. Perhaps the FASB solution might be one that provides some pointers on that.
Thank you, Ram. So that will certainly be something that we might look at when it comes to that stage, and then look at this in the Australian context. We've had a panel question on providing views on segment cash flow information, and I think, Ken, you would like to share your ideas?
Oh yeah, sure. There are some times when in debt again, like there's if you ask equity investors and debt investors these questions, you'll end up with quite different answers. I'll sort of just start with that point, which is why I might say different things to say what Nick or Millicent has found from their sort of questioning. But from a debt holder's perspective as well, sometimes debt is issued out of subsidiary as opposed to holdco. And so you then would want the same kind of information that we're talking about at the level of the debt issuer itself, and that argues for cash flow information and whatever else you can get at that level as well. So that's one place where it's useful. In some other situations, again, companies which are strongly value using discounted cash flow type things, that's again property, resources, infrastructure, that kind of arrangement as well. Sometimes you want to run some of the parts. And it's best to do that again. That's another reason why you might just go into underlying segments and prefer to sort of value each one of those pieces separately. Maybe you might use different valuation methodologies for different parts of the business. And for those DCF-oriented ones, then you certainly want to have that information. But it's not super common.
Thank you, Ken. And I think Rebecca also wanted to share her ideas, and then Nick.
Yeah, I mean, to Ken's point, I get why it's really useful, but on the flip side, it's incredibly difficult to produce. So we had similar issues actually when AASB 16 and AASB 15 came in, and they were asking us, particularly in the property industry, to split between lease-related debtors and non-lease related debtors, because obviously the flip side of that is cash. A lot of the time, particularly if you've got, in my industry, the same tenant across multiple segments, and so it's really, really common in property, for example, to have big supermarkets both in retail assets and with distribution centres in your industrial assets. Often they'll just give you a big lump of cash. So who did they pay you for? You actually don't really know, and a lot of the time you have to try and unpick that, and that can take a lot of time. So you know how much cash you've gotten from them, that's fine, and you can certainly define that at an entity level. But it's very difficult to go and ascribe it to a particular segment until you've actually managed to work through that with the customer. And often you've got a reporting deadline that falls right in the middle of that, and you haven't actually finished that exercise. So that can make that quite challenging. The other component that Ken touched on is pooled debt. So, if you're looking at a particular acquisition, you'll look at your incremental cost of debt in terms of financing that acquisition. And so, your return will then be modelled on that incremental cost of debt. But ultimately, you'll go and refinance that debt over time in a pooled fashion across multiple segments. And then that sort of return in terms of that debt matching that particular acquisition is lost. So what you'll often find is that a lot of people, they report their segments in terms of their P&L, and they've got this column that says corporate and other or whatever, and all of their debt is chucked into that one bucket. And so, even from a P&L perspective, you'll find that people can't split that cost in an accurate fashion. If we did, it would often just be sort of an arbitrary value split. So could we provide the information maybe? Would it be accurate? No.
So it sounds like there's a bit of a challenge there. Nick?
Yeah, so first, probably echoing what both Ken and Rebecca both said. I mean, what we heard, well, one, it's not often presented by segment. From the user side, we generally heard it would be useful information. Many said they would really like to see that. We didn't necessarily see the distinction between debt and equity investors, as Ken mentioned. It was more of a message of, yes, that's useful information. But then from the, as Rebecca's pointed out, from the preparer side, we did hear some of those same challenges, particularly where you have common costs across segments. Tax was one that was pointed out, often financing. Usually things sort of outside of operating were talked about as being more likely to have these sort of comments, so the financing that Rebecca talked about, that are difficult to separate out amongst the segments. There was also maybe an overriding message, particularly from the investors as well, saying that there is a reserve project for segments more widely, not just about cash flows, and the agenda consultation for the IASB is coming up, and so some said they would rather see a holistic view, relook at segment reporting rather than doing something discrete within this project specific to cash flows. So maybe that little extra piece of information, but I think we heard very similar things to what Ken and Rebecca said from respectively investors and from preparers.
Thank you, Ken and Rebecca and Nick. So one other question that we had was that under IAS 7, the 90 days for liquidity purposes, and we've obviously heard that this might not just be as straightforward. So why is that an issue, and is it still relevant? Rebecca, maybe can you start off this item?
Yeah, sure. Look, at the top of any balance sheet sits your cash, and the reason that's up there as number one item is that it's your most liquid asset, or at least it should be. I actually find the 90-day distinction quite long from my perspective, because you're going to have receivables on there that are ranked further down, which admittedly you don't have as much certainty around receiving, but you're going to be receiving, well, that's going to be a liquid asset to you much sooner than the cash item is. So look, if it was up to me writing the standards, and I'm probably going to be unpopular for saying this, I would probably go with a shorter definition, to be honest. Only because I think that, people are really looking to see what it is that you can pay immediately with that cash. The second thing that I would sort of go back to, which I think Ram touched upon before, is restricted cash. Restricted cash isn't just an issue in the not-for-profit sector, although I certainly get that they've got a more prevalent occurrence of restricted cash. So I work in the property funds management sector, and we have AFSL licenses, and a lot of those AFSL licenses are secured with cash balances. But you can have cash balances that are backing up a range of different obligations, such as guarantees and a whole bunch of stuff. So all of that cash at the moment is sort of sitting there as cash. Could I spend that cash? Yeah, I could, but I would, fundamentally undermine my business. Excuse me. So I think it's really important that, I think it's really important that there is a requirement to call out where cash has a restriction, and I think that that's not necessarily covered in the standard at the moment. A lot of people in my industry do elect to call it out separately, because otherwise people will make the wrong assumption and think that that cash is free and available to spend on things, which it's not.
Okay, and Ken, user perspective.
Yeah, on the restricted cash, I've got to say that's, again, from a debt holder's perspective, really important. And often if a company is getting into some distress, I'll just say without naming names, it sort of gets opaque. And only later down the track will they actually disclose some line item that sort of says, oh, actually, off the cash, this part we can't actually spend, and it would be pretty bloody good to have that up front rather than sort of shaded down the track. I think that probably could be looked at. On the 90 days or less, I guess for my purposes, what matters is that if it's 90 days, then in some senses, I was thinking in terms of like money market funds or some short-term park, you might be in something which is highly secure. You might think of it as a managed fund in some cases that is low risk, that you have a very, very high likelihood of getting all your money back and being able to liquidate that in a short enough period of time that you can pay your debts upcoming. And with the increased use of the non-bank financial institutions market and decrease of the use of banks, not massive at the moment, but it's definitely heading in that direction. Then what used to serve as a deposit can actually be held outside of the banking system and be regarded as cash. So for those sorts of reasons, I think what matters is that they can get it is a very firm valuation, and you can get your money back via the sale of it or redemption of it. in near enough such that it functions as cash, to me, for my purposes, might as well be cash. And that probably gives me more information than having that held as marketable securities or something like that, right? So for those reasons, I was actually okay with 90, but I hear the arguments otherwise. But I think that the concept about restricted cash is definitely needs to be looked at and addressed.
Well, thank you very much, Nick. You're getting more work to do. So
Yeah, if I could maybe point out,
Yeah.
it's very interesting that Rebecca and Ken, your views, because it's almost the reverse of what we heard in our outreach, that normally it was sort of the investors that we're pointing to. We'd like cash to be as close to cash as possible and as liquid as possible, and even 90 days is pushing it. Whereas from a lot of preparers, they said, well, look, operationally, there's a lot of things out there that we can, that we can settle at our risk, that at very low risk, we can use to settle debts. And particularly in some jurisdictions, we notice this is quite common practice to use things that sit outside that 90 days as a cash instrument for things like buying inventory, settling debts, etc. So interesting to see that the difference in views here from what we heard from sort of the general population in our outreach.
Oh no, I was in the 90 days is pushing it as well category. So
yeah, no, but it was sort of usually it was the investors telling us that, not the preparers.
Yeah, not
Usually
the preparers.
were more
Yeah.
yeah, no, exactly. Yeah,
yeah, and we happen to offer funds that might suit that category, so perhaps I'm biased.
Yeah. There you go.
Well, thank you. And we've got time for one last question from the audience. And so the question is whether we think that removing the cash in transit transactions being excluded from cash and cash equivalents has improved the cash flow statement. Rebecca, what are your thoughts?
I'm not a huge specialist in this area, but I will say that probably this is more of an issue overseas than Australia, and maybe financial institutions, suffer from this more than Australian institutions, because in Australia we've been granted the gift of OSCO, where I don't really have cash in transit anymore, and I haven't used checks since about 10 years ago. So the old bank reconciliation. Yeah, maybe.
Might be a bit of a government question as well.
Perhaps. In which case I would say to the public service, look, get on board and stop accepting checks and start to organise your financial systems to be more real time, and that will solve the problem. Because to be honest, the only time that I ever draw a check these days is generally for government payments.
Yes, and I think there are some developments in that area. Yeah.
Yeah. But look, do I think, if those payments were to still be, in existence, should they be cash? Yeah, I mean, look, I think that generally they're in the background somewhere with a financial institution, and, they're generally regarded, when it's not the GFC, to be fairly safe institutions that you'll be getting your money back out of. So, and look, they'd certainly meet your 90-day threshold. So I would say that in my mind, they should be cash.
All right. Thank you very much. I think that is all that we have time for today. It's been a very insightful session, and I would really like to sincerely thank the presenter and the panelists and the audience for their contributions and thoughts and ideas. So as usual, Dialogue Series is recorded and we'll make it available on our website. Thank you everybody again, and we hope to see you at the next Dialogue Series. Thank you.
Thank you.
Bye.
Thanks, everyone.
Thanks. Bye.